Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, welcome to the latest edition of the ASB Investment Podcast. As always, I'm your host, Nigel Grant. In this latest episode, we're going to dig into what's been happening in global markets, both here in NZ and abroad, but probably more so in terms of from an economic sense, locally and what's happening internationally, but probably mostly the impact that it's having domestically. So today I have someone who will be, I think, familiar to many people. I see him all the time. He's on radio, he's on the telly. Him and his team are sending out research constantly to provide updates on what's happening left, right and centre. It's ASB's chief economist, Nick Tuffley. How are you, Nick? And welcome to the podcast.
I'm good, and thank you for having me along.
And first up, like we always do for all our guests, to put you on the spot, but tell us a little bit about what it's like to be the chief economist for ASB and what that means for you day-to-day in your role.
Well, I think we end up having quite a varied role because just in the course of a day you can be doing a wide variety of things. So occasionally in the mornings I'll be getting up at 5 or 6 to do a live radio interview. So that's how a day might start.
I've heard them.
Yeah, thank you. There's someone out there listening.
Yep.
And then we'll be doing some data analysis. So people in the teams might be writing some reports and I'm editing those and working through on those. We could be getting ready for some presentations, and we do quite a bit of internal work as well. There's lots of things that the bank itself wants to know. It's a huge business, and it wants to understand the environment that it's in as well.
And it goes to the brain centre.
Well, I think there's that expectation that we know everything about everything, but perhaps not always. But we're certainly a font of knowledge on a number of things that can impact the bank.
You're probably going to know the most. I'd say the odds are that you'll know is probably best.
Yeah, or know how. Okay. How we can find out, how we can know.
and as the chief economist, what does the chief economist like to do in one spare time?
Well, I have 2 young girls, 8 and 11, so to the extent that you've got what you call spare time, there's a lot of time spent with them doing all sorts of things where it might be going for bike rides, playing on the playgrounds. And they're at that great age where you can do things with them like ice skating and other activities and just having fun. So that's part of it.
Yeah.
I also do Aikido, which is that martial art that Steven Seagal, those of you can remember him before he got fat, that one where you sort of wave your hands around and people mysteriously go flying through the air. So I'm probably about halfway on the road to getting my black belt. So
are you?
Yeah.
Oh, congratulations.
Yeah.
I'll make sure I don't say anything or ask any questions that would warrant a Steven Seagal-esque clip around the ears. So in terms of getting into the discussion today, to kick things off, in terms of starting as generalist as possible, what's the general update from your team and sort of the perspective on things out there in the local economy? One question that came to mind is kind of, if you listen to enough talk back, are things really as bad in the economy as they seem in the media?
Perhaps not that bad, but look, there's a lot of challenge out there. We've got an economic environment where things are pretty flat, even going backwards, to a certain extent, not much. And there are people who are under pressure. It's quite varied across the economy. I think it really depends on what industry you are in. Also, as a person, where you are in your stage of life.
Yeah.
So if you're in the mortgage belt, so you've got a whopping mortgage, boy, are you absolutely feeling the heat. But if you are through that stage of life where you don't have much debt and you have a lot of savings, it's been quite different. And I think also people who've been on low incomes have really felt the pain because food prices, with the inflation in that, was very strong at one point, and rents just keep going up, and fuel prices are still pretty high, and those things chew up a lot of some people's incomes.
And to that point, is it what is being felt impacting that section of the populace the most, right? So if you've maybe done well for yourself, sort of immune from it or not immune?
You'll still be feeling some impacts because I think one thing we've got to remember is the cost of living for everybody's gone up.
Yeah.
You've probably got more resources to deal with it if you've got more savings in the bank account. Your interest income will have been going up, although after the tax man and inflation have had their bite, you perhaps aren't feeling quite so rich. But you've certainly been having a easier time of it, or a less challenging time than if you had a huge jumbo-sized mortgage, 2 people working flat out and really struggling to make those payments. Sort
of just treading water as such.
Yeah.
And ASB recently suggested that I guess, from what the economy needs to kind of help and supercharge some of those issues that you're talking about, that's sort of impacting everyone. Are we facing a $1 trillion, in my Dr. Evil voice that I won't impersonate, but a $1 trillion infrastructure bill? So, what does that mean for the economy, and how are we going to pay for it?
Yes, there's a lot in there. So Mark Smith and Jordan Campbell and the team spent a lot of time working through on that infrastructure piece. So if we wanted to get the standard of our infrastructure up to the OECD average over the next 30 years, we'd have to spend about that $1 trillion. I won't use that voice either. And that's a lot of money. Like, we may not end up spending that in practice, but in reality, we do have an enormous infrastructure deficit, so to speak, to catch up on, and just to make sure that we continue to keep up with our population growth, which is likely to remain fairly reasonable over time.
And is this deficit unique to us?
It's around the world, and you start talking about multiple trillions of dollars when you go around the rest of the world. So we're all kind of in the same boat. Countries like the US in the past, massive amount of, say, post-war spending on infrastructure. Some of that's kind of crumbling now. That's before you start sort of ramming ships into bridges as well. And the other part of it is, climate change is meaning that the infrastructure needs to be a lot more resilient. So instead of what we would have thought of as a 1 in 100 year sort of weather event is now a lot more frequent. The need for the infrastructure to be more durable and probably more expensive when we replace it to a much higher standard. We've got those issues as well.
And to back to the kind of question of whether you have a view on this or not, who pays for it?
Well, there's two parts to say. There's who funds it and who pays it. So ultimately, ultimately, we're all going to be paying for it as users, whether it's as a taxpayer, as user pays, as a rate payer, in some or paying a toll or some sort of fee. So ultimately, we are paying it. But in the meantime, who's funding it? Look, we need to start looking and being a lot more flexible. And traditionally, we've said, okay, the government's just going to raise taxes
or debt
and pay for it, and they will own it. The government can't do everything, and I think we're finding that with the even just the amount of debt we've taken on in recent years. So we need to look at how we can get private sector money in there.
Hybrid sort of thing.
Yes. So you've got your public-private sector partnerships. How do we get foreign investors in as well? So I think what's important is that we have the infrastructure and bicker a little bit less around who owns it. It's important to have the right infrastructure.
I guess, once a bridge or a tunnel's in, and it's a bit like, you lose sight of the debate that was on funding potentially.
Yeah, look, no one's going to pick that bridge or that tunnel up and take it somewhere else. The infrastructure is there as well.
And speaking of debt, a lot. That's one way of segueing this into the next kind of question. A lot of people want to know what's happening with the OCR or the official cash rate. If you didn't know what that sort of acronym is, that we speak in acronyms all the time in banking. But I don't think I recall a period, and you can correct me if I'm wrong, where I recall there's being so much interest in a policy rate. Like, it's a monetary policy renaissance. But generally, where to from here, do you guys think?
Well, we do think that the Reserve Bank won't need to lift the official cash rate any further.
Okay, phew!
Yeah. So that will be a relief to a number of people, virtually anybody with debt.
Yeah.
The issue is how long they're going to need to leave rates on hold. And it's been virtually a year already, and we think it's likely to be into 2025. It's just what is needed to actually get inflation back down. That's the challenge we've got at the moment is inflation's remaining pretty sticky. Even though we've got an economy that's essentially flatlining, inflation is being very slow to get back down.
And so just to be clear on that point, you guys believe the rate will stay where it is until, was it early 2025?
We're picking February 2025, so that's when the first meeting of the year is. It's the full monetary policy statement where the Reserve Bank does its most detailed forecasts. There's still a chance that the Reserve Bank could cut rates later on this year, but we've only got two more inflation outcomes that come out before then, and you'd need to see quite a material shift in the inflation picture in that time to have the Reserve Bank confident that the job is done enough to start cutting rates.
Because we don't report monthly, we report quarterly Yeah.
Yeah, it's every quarter. At least it's in the middle of the next quarter. So, for example, when we're looking at the September quarter, which is when we think inflation will finally be back below 3%, we'll get that number in mid-October. So compared to our GDP figures, which come out at the end of the following quarter, it's certainly a lot faster.
Okay,
but we don't have the monthly updates that many countries have.
And do we have one of the higher central bank rates in the developed world? I know we've talked about New Zealanders have been feeling the pinch, but, if we do, are we going to come out the other side sooner than other nations, do you think?
Well, we're quite a way up there. We're basically in line with the Federal Reserve, and most countries are lower. Australia's over 1% lower than where we are, and the Bank of Canada fractionally lower, in Europe lower. I think the issue is we went up first. The challenge is we are probably not going to be first to come back down, and that's because I think from a New Zealand point of view, whilst we may not have had the sheer peaks that some countries had, like say in the UK you were pushing up to about 20% because of energy price bubbles at one point in time, the issue is that persistence, and our inflation is a bit slower to come down. It's sticky, and it's particularly that sort of service sector, sort of non-tradables, that sort of domestic related inflation that's related to capacity pressures. That's taking a long time to come down, and that means the Reserve Bank's likely to be holding on here a little bit longer than, say, what we're likely to see for the US or the Reserve Bank of Australia.
Yeah, because listeners will know that I am a nerd for this sort of area of discussion, but I guess from US markets and commentary, sort of this week's discussion has been, the Fed wants to cut. They want to cut from some commentators, but you're suggesting maybe that, here we're a lot more patient, or we're going to wait to see the whites in inflation's eyes before we do it?
I think for everywhere, it's a case of wanting to be on top of inflation. So I think that's the outcome they really wanted to achieve.
Yeah,
it's perhaps a little bit less about want to cut or not. It's just wanting to do the appropriate thing, and what all the central banks have learnt the lesson from last year, where as soon as rates stop going up, everybody starts going, right, well, they're going down. Yeah. And then we've seen inflation just keep surprising by how long it's held up. So I think we've got a wariness. Central banks know that they're getting there, but they're just not sure they are there to the point where they can start cutting rates. I mean, I think they would like everything to be back to a point where economies are growing at a reasonable pace. You've got good job creation, you're not shedding jobs, but they need inflation to be under control for all of that to be sustainable.
And do you think that's multiple quarter reports that sit under the 3% target? I'm just thinking, within that 1 to 3% target range, does it have to get there, or the trend, is sort of showing that it's on its way?
Perhaps a little bit of both. I think what the Reserve Bank wants to be sure about is that it can cut rates, yet inflation will gravitate to 2% if it's not already there yet. And once it's there, pretty much stay around 2%. They're aiming for the middle of that target band. It's like anything when you're trying to shoot something. You aim for the middle of it. And hope that you hit.
Yeah.
But they're doing it with their eyes shut after they've been sort of spun around a few times and then sort of straightened up. So it's pretty imprecise.
Yeah.
So they want to be sure that they can cut rates and still have inflation sit basically around the midpoint of that target band. Getting inflation back below 3%, back in the target band, that looks at this stage like that's a pretty minimum requirement.
Yeah.
I think what's important is it's about the mix of inflation as well. So virtually all the fall inflation we've seen so far is in traded goods and food and fuel prices. Yeah. So it's a lot of that sort of imported related inflation. It's not being driven down by sort of a material easing yet in capacity pressures. So they want to see the signs that what we call like the core inflation, which is where you kind of look at you strip out the extremes, look at the sort of like rump of inflation. Is that looking like that's generally either near 2%, or they're confident it will keep heading down to 2%. So it's there's not going to be any sort of magic number where they go, yep, we're down to 2.75%. Let's cut.
Yeah.
It's going to be looking at just what's the sort of totality of all these sort of various measures that give them a sense of, by and large, most prices looking like the increases are, fairly contained around that 2%.
And I sent a note to myself during the week, as one does, but I happened to be walking my dog at an ungodly hour of the morning, and my mind went to, you've mentioned it already, like sort of that non-core stuff, or the rent and gas prices, right? Stuff can fluctuate around. But my question I wanted to ask you was, the higher these go, can it lead to decreases in everything else? And it's almost like a counter influence on those things.
Look, in some ways it is, because what essentially we're talking about is that we just start buying a little bit less stuff than what we were going to, and that drives demand back down towards what we can sustainably supply, and that's when you get inflation back under control. So when you have things like food, things that are classed as a necessity, like food prices going up, you still tend to spend on food, but you're probably going to be moving away from the things that cost a lot. Look, if tomato prices double over the month, yes, that gets counted as inflation, but we probably just don't buy any tomatoes. There's a person who hates tomatoes unless they're in a can or in a sauce bottle of some kind.
Noted. Yeah.
So we do probably substitute quite a bit, but there's that sort of crowding out effect. When your rents are going up, your food is going up, it's difficult to reduce your spending in those areas. When fuel prices go up, if fuel prices double, we don't sort of halve how much
fuel we use.
Yeah. We may walk down to the letterbox to collect the mail a little bit more than what we do. We might change our habits subtly, but you do end up crowding out some of that other spending. So it can have a bit of a dampening impact. Particularly, that's a curious thing about oil prices going up, is that it will push up headline inflation in the short term, but it has some sort of impact on dampening your wider demand. So I think the thing is, what we're doing is we're having to prioritise quite ruthlessly. We, believe it or not, the volume of sales going through the supermarkets is actually down despite population growth. So we seem to be taking home less collectively from the supermarkets. We're spending less on durables, as an example. So we're not spending as much on the furniture or the cars. But weirdly enough, the last thing we're hanging on to is services and experiences.
Travel. Yeah.
So one of the things I ask often when I do presentations is it's getting a bit outdated now. No. Any Swiftie fans? Yep. Did anybody go to the concert?
Yeah.
And you'll get a few answers. So you're saying we're probably spending on what we see as important.
Yeah, right.
So that sort of... So to some extent, that sort of necessity, luxury thing that's got a bit blurred. We're spending on what is important and cutting back on the things that we deem not and we're not so attached to.
So as a derivative to what we've been talking about around rates and their impact on economies or our wallets, one of the key downstream impacts that's certainly applicable to this podcast is kind of, its impact on asset prices and portfolios. Share markets around the world have had a good run over the last 15 months, even while central banks have generally held the rates high. So what's the view on, how does this continue to play out? Can asset prices continue to hold up, I guess, within this environment?
Yeah, I'll probably divide it into a few things. I think some of those sort of real assets like property, which have been sort of much more affected by just the debt servicing costs, and also like a deemed rate of return as well, particularly in, say, commercial property. As rates come down, I think we'll see asset prices in that area go up.
Sure.
Share markets, perhaps a little bit more mixed. When I look at the New Zealand market, it's been what I probably call well-behaved when you think about the environment we're in, where it's tough times. The market's been going pretty much sideways for a couple of years. So there's probably that sense of potential, I would say, for as the outlook gets a bit rosier, for there to be a bit more sort of optimism priced in. The US market is the one where I sort of always have a bit of a question mark around, because it certainly did have that time where it went sort of sideways down when there was that worry that higher interest rates would kill the US economy and the global economy, and that would be the end of the world. But the last year, it's just like taken off, and it's reversed. That focus. It's really focused on rates are coming down. Yes, they're going to come. They're going to come down tomorrow. Yes, they're going to come down tomorrow. Yes, they're going to come down tomorrow. They're going to come down tomorrow. So that's for the market where I'd sort of question as to, is it already sort of well pricing the easing cycle? And look, I think fundamentally, for the share markets, it's back to you need to see that revenue or more earnings growth coming through, and for that to be sustainable. There's probably a bit more scope for that sort of cyclical earnings cycle to pick up in New Zealand and get reflected. The US, it always seems to be a case of if there's bad news, that's great because the Fed will keep rates rates down quicker, and that'll make us all happier. Or the economy's going really well, so earnings growth is going to be great, so let's buy stocks as well. So I'm just a bit nervous that market often tends to price the good news out of everything.
And do high rates for savers, I guess, what they earn on TDs or cash at the bank, do they stoke inflation?
Well, when you look at, say, New Zealand, we've got about $240 billion of household deposits, but we've got over $370 billion of household borrowing. So, when interest rates go up, you might find the savers going, yippee, I've got more money to spend, but you've got a whole lot of people going, oh my goodness, where are we going to find money for the mortgage? So the impact on consumer spending is unequivocally, we see it overall pull back. And when you're in a time like this where there's a bit of nervousness, you're getting all the daily headlines about, 10,000, jobs got lost last hour, what's happening next hour, people start to, they get a bit more worried about, okay, so what's my employment prospects like? Yeah, so I'm just going to be a little bit more careful. I'm going to save a little bit more as well.
Yeah, I think that point, it's really good insight in terms of actually, for some, they might prompt spending, but if you put it in proportion of where the amount of money held in either side of the balance sheet, it's quite stark.
Yeah. And it can be that savings can be quite tightly held in terms of the big chunks of it. So you're down to, it's all about psychology, how confidence is everything. If people feel confident to spend, they will. If they're worried about something, they'll hold back.
And I was thinking in preparing for this, typically one of the go-to barbecue conversations, or I was, whatever the autumnal equivalent for a meal is, I couldn't think of it, that gathers people on the table. One of the conversation starters at these events in the past has been, NZ housing prices. I think recently it's been probably more dueling with maybe, where's rates going or aren't mortgage rates up. But, what's the forecast for house prices and how's that changed recently?
Well, we think house prices will overall go up this year, perhaps around about 5%. They've been gradually edging up over the last year, and we think that'll keep happening for much of this year. There's not a lot of momentum there at the moment. The market has certainly turned the corner. Sales turnover is up a little bit, but you're also seeing people go, right, the market's turned the corner. I can get rid of that house I didn't want to hold. So you're seeing more listings come on as well. So that's sort of keeping a bit of that supply versus demand sort of tension there. It's really when interest rates come down, I think, is when we'll see that market pick up, and we'll see prices rise a lot more noticeably next year. And that must
be one of those other data points that the Reserve Bank is keeping a very close eye on, right?
They do. I think for them with the housing market, it's with the inflation hat on anyway, it's like, okay, if we have a big house price boom, everybody gets happy, they go out and spend. But at this stage, look, there's very little for the Reserve Bank to worry about because we're really, cutting back on our spending.
Yeah, it's okay. 5% this year seems pretty tolerable. But as we know with forecasts, I'm sure you'd agree, it can go either way, depending on which way the wind blows.
Oh yes, look, we've had a few house price changes over time. I think when COVID started, we were predicting, we had the most optimistic forecast out there, and that was for about a fall of about 6% or so. Yeah. We were right. We just had the wrong sign and forgot to multiply by 4. But that was the best forecast in the market at the time.
Oh well, kudos to you. I mean, humble little brag there. And we'll go to the final question I had was more around immigration. It's always a go-to topic around election time. It's always a talkback focus. Shows how much I listen to talkback. But with net immigration at a record high, I personally don't know how the airport is keeping up with it all, everyone coming and going, but we're seeing a large number of people leave NZ for supposed greener pastures, but also more are coming back the other way through the arrivals gate. Is this sustainable would be my question, and then what are the impacts both short and long term?
I think the answer is it's not sustainable. We're going back to that sort of $1 trillion figure we were throwing around at the start. Look, the infrastructure pressures, we can't keep up with that sort of growth, so it is likely to cool, and the government will make that happen one way or the other because it can just tighten the arrivals criteria. Yep. what we have is we've got over 250,000 people coming in, and over 100,000 people leaving at the moment. It's massive flows in either way. It's a massive record on the way in. So we're both picking up fresh labour to help with some of those skill shortages, but we're also losing a lot of skills as well. And the net outflow of New Zealanders is quite high. It's over 40,000, roughly about 40,000 New Zealanders on a net basis leaving over the last 12 months.
It's like citizens, is
That's
it?
NZ citizens, I should say.
Right, yeah.
So we're losing a lot of our homegrown talent, and there'll be skills we're losing in that as well. So it does make it a bit challenging when you're looking at, how does this pan out? It's certainly helping boost the labour supply.
Yeah.
But there'll still be some skill shortages in some areas where we're losing some of those valued skills, even if we're getting different skills coming in.
And apart from policy setting changes, what do you think would is there anything that would result in reduced levels of immigration? So I guess people coming in. Well, I think that's leaving, isn't it? E is the leaving.
E is the leaving, I think.
Is coming in. Okay, yeah. Okay. What would lead to less leaving, I guess?
I think part of it is we're just going through a bit of a post-COVID phase where people who wanted to do their OE are now doing it. And I think that'll abate to a degree. The other thing is, our own economic performance. Our economy is weak relative to a number of countries. And I think as that performance picks up, we'll see more people wanting to stay here. So that will help. And in some ways on the inflow as well, that will moderate. We're tightening up on the work visas, which has been where a lot, a fair chunk of the growth
I always think
coming in.
There's always the group that are going to leave regardless of what we've been talking about. I always think of the OE group, but I guess there's also the ones that are looking to, my life potentially or job prospects could be better if I wasn't here, right?
I think that's that thing that people look at. You go to, say, Australia, which is where I think we're typically losing people to.
Yeah.
You do get much stronger wages after tax, and your living costs aren't really that different to here. So you're materially better off in that point of view, even if you're at more risk of something poisonous biting you as well. And UK is another place where we've
always gone to,
go to as well.
Yeah, I mean, don't listen to that advice. Stay here and help us out. So we're nearly at the finish line. Any day I can talk fiscal and monetary policy with anyone apart from my the mirror at my house is a great day. So I want to thank you for breaking down these topics with us. The final question as we wrap things up, and I ask this of everyone that comes in, is what's something you're reading, watching or listening, it could be, that you could share or recommend with listeners?
Well, I tend to have a sort of mixture of things that I do. So some of the more trashy things are just to entertain myself. So I've been on a bit of a Guy Ritchie phase this week. So The Gentleman on Netflix, the TV series. Yep. Not as good as the movie, though, which was excellent. And
that's good to know.
Lock, Stock and Two Smoking Barrels sort of rewatched again as well. But sort of on a more serious thing is, I've started, this is probably a time to be thinking about podcasts around, or like this, but around sort of opening your mind up to what's happening in the investment world, and sort of getting prepared for the fact that look, we might be talking doom and gloom at the moment, or hopefully not too much today, but thinking about things that will inspire you and set you up for the next year or two, because things always get better, and there's opportunities, and often the opportunities are when a lot of people aren't looking.
That sounds very zen.
I'm trying to be.
Well, speaking of that, I've been reading. Listeners will know I read a lot of books, but Rick Rubin's new book on the Creative Act, which for those that don't know, Rick Rubin is one of the world's foremost music producers who's barefoot now and sort of has a big white Santa beard. But he's written a book called The Creative Act, and it is untold chapters of no more than 3 pages on very various topics, and it fits in perfectly with what you've said. It basically practice patience, keep zen on multiple things. A good idea can be the right idea, but just at the wrong time. So plant it back in the ground, and so it's keeping me very zen in this troubled economic time. So that's all for today's episode. Thank you for taking the time to tune in as always. I hope you found the information useful to make you sound smarter around that autumn dinner table, but more seriously to help you make sense of everything that's going on, what you're hearing, and any key financial decisions that you or your families may have coming up this year. Again, Nick, I want to say thank you for popping along. I hope you have you back again soon.
It'll be a pleasure.
And so until next time, happy investing, and it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.